$63 billion vanished from a company called Enron, not in a fire or a war, but because Enron wasn't built on products or property or anything you can touch. It was a $63 billion business that traded only air. One day, Enron was worth more than the GDP of small countries. The next, its apps went dark, and millionaires watched their portfolios flash red. People realized what they owned wasn't a thing, but an Enron promise dressed as a thing, and the story Enron sold shattered. So how did Enron turn air into an invoice? How did an Enron handshake become a valuation? This isn't just a story for Wall Street. The collapse of Enron showed up as delayed paychecks for its employees, canceled contracts for partners, and wiped out savings for everyday investors. Ordinary people always meet the bill last and pay it first. Outrage at Enron is easy. Understanding how they did it is power. In this video, we're not just pointing fingers. We're going to slow their entire operation down, frame by frame, until you can see exactly how the trick was done. And if you want to make sure you never miss when we break down a story like this, make sure to subscribe to the channel. It's the easiest way to build that filter we're talking about. By the end of this, you won't just know how Enron fell. You'll see the entire world of finance differently. You will become difficult to fool. Let's begin. It began the way most revolutions don't, with pipes, valves, and invoices that smell faintly of dust. Enron was born in 1985 from a merger of two pipeline companies, Houston Natural Gas and Internorth. Its job was simple enough to lull you to sleep. Move molecules from one place to another, measure them, and charge a regulated fee for the privilege. No glamorous launch parties. No keynote stages. Just engineers in steel-toed boots, clipboard that caught the rain, and a monthly rate sheet set by someone in a gray building far away. Dependable, yes. Dreamlike, never. Then a certain kind of executive arrived. The kind who reads footnotes like treasure maps. Kenley, an economist with a politician's smile, saw something others missed. Deregulation. What if the price of energy wasn't fixed by a commission, but shaped by buyers and sellers in real time? What if gas could flow through markets as easily as it flowed through pipe? To the old guard, it felt like suggesting jazz inside a cathedral. To the spreadsheet faithful, it looked like tomorrow's prophet walking through today's door. To a utility, deregulation was like stepping off a curb and discovering you could hover. Suddenly, Enron didn't have to wait for a bureaucrat to bless a penny of margin. It could trade. It could hedge. It could arbitrate weather, geography, and time itself. Price stopped being a rule and became a conversation. And if you could speak the new language, options, swaps, forwards, you could turn tomorrow into today's earnings and call it efficiency. That's when the true pivot arrived. Not only would Enron move gas, it would market the future of gas. Think of it like this. Once you waited for a delivery truck. Now you click the button. They built platforms where energy contracts change hands the way pizzas change hands on a Friday night. Thin crust, extra hedging, arrives hot. Counterparties matched, bids flashed. Spreads whispered their secrets. The molecules still rode the pipeline, but the money rode something faster. Belief. Rebranding followed, as inevitable as a costume change after intermission. Hard hats, me hoodies. The utility became a platform, a market maker, a technology company that happens to touch energy. Jeff Skilling, a former McKinsey consultant, pushed the idea that Enron wasn't just an energy at all. It was a tech firm, a Silicon Valley startup in cowboy boots. The boardroom learned to pronounce scalability with a West Coast accent. No one wanted to be the last dinosaur selling throughput when everyone else was selling a story. And what were they really offering? Air with spreadsheets, promises about flows, prices, and probabilities pressed into cells and sold as clarity. Inside the building, identity shifted. Engineers who once bragged about compressor efficiency now compared Sharp ratios. White boards filled with Greek letters that had never seen a refinery. The culture rewarded velocity. Deals per quarter, not miles of pipe per year. If you could package risk in a way that looked like innovation, you were a prophet. If you spoke in acronyms, even better. Acronyms are confidence with vowels removed. People felt taller, just walking past the trading floor. The outside world fell hard for the new costume. Fortune magazine named Enron America's most innovative company 6 years in a row. Analysts issued by ratings as if missing it were a professional sin. Economists applauded the elegance of price discovery, the way markets allegedly vacuumed waste. Conference stages handed over microphones, and the slides sparkled. Growth curves rising like sunrises, addressable markets measured in continents, network effects drawn as halos, authority piled up like glossy covers on a coffee table. Investors did what investors do when a narrative clicks, rush the door before the music stops. The share price responded like an obedient dog. Each quarter sounded like a victory lap. New products, new markets, new partnerships. The CFO polished the sentence that mattered most. We are unlocking latent value. We are monetizing volatility. Translated. The machine is humming. Please don't ask where the belts are. Maybe you feel the pull of it too. The promise is intoxicating. A dull Houston pipeline firm reinvented as a fast, clean, scalable platform. Who doesn't want to believe discipline plus software can turn pipes into prosperity? But hold that thought. The trick with great stories is how easily they hide the gears. Over the next turns in this tale, we'll slow the picture until the moving parts come into focus. You'll see how confidence becomes collateral, how forecasts become revenue, and how pizza became a metaphor for selling the future. Enron's magic trick was simple in design but dazzling in execution. It convinced the world that the future could be sold in the present. No longer limited to shoving natural gas through pipes, the company announced it could trade contracts, hedge risks, and bet on outcomes that hadn't yet happened. Imagine betting on whether it rains next month, then reporting the payout today as if the storm had already passed. That was the rhythm of Enron's profits. Markets loved it because it looked like innovation, but really it was leverage dressed in Silicon Valley clothing. The engineers were still counting molecules. The accountants were now counting wishes. This is where mark-to-market accounting entered the stage. In ordinary business, you book revenue after you've earned it. You sell a product. The money comes in, then the line shows up on the balance sheet. Enron decided waiting was old-fashioned. With mark-to-market, the moment they sign a long-term contract, they treated all 10 years of projected profit as cash in hand. If a deal promised $5 million a year for the next decade, Enron wrote down $50 million today. Never mind whether the deal actually produced the money, or whether the customer stayed solvent, or whether the market shifted. They declared the chickens hatched, fed, and sold before the eggs even touched the nest. On paper, this looked like alchemy. Numbers surged. Earnings reports glowed. Analysts flipped open the quarterly filings and saw riches multiplying faster than a calculator could catch up. They asked the obvious question, how does Enron make so much money? But the answer was a blurred jargon, 40 minutes of buzzwords, and a shrug that suggested you weren't quite clever enough to grasp the genius. That's the thing about illusions. They rely not on what you see, but on what you don't question. Investors, meanwhile, felt brilliant. If you bought in early, the stock rewarded you with the thrill of exponential growth. From $7 a share in the mid-1990s to more than 90 by 2000, it looked like Enron had found the cheat code to capitalism. Buying Enron wasn't just investing. It was joining a cult where the smartest people in the room finally had their day. Who wouldn't want to belong to that? It's easy to mock in hindsight, but put yourself in that era. A company labeled most innovative year after year, an economy obsessed with disruption, and a stock chart that climbed like a rocket. Missing it felt like missing the internet itself. Inside headquarters, the culture reflected the mania. Employees were told they were the elite, the chosen, the rare minds capable of bending markets to their will. Skilling reinforced it with a Darwinian ranking system where the lowest performers were fired annually. Bonuses were tied not to reality but to reported numbers. So everyone's incentive was to inflate today and let tomorrow deal with the bill. Meetings were blood sport. Deals were currency. Loyalty was to the stock price alone. People worked like their reputations depended on it. Because they did. Survival meant feeding the illusion, closing one more transaction, reporting one more victory. The absurdity, of course, grew thicker by the day. Enron began structuring deals that barely broke even in real terms, but thanks to mark-to-market, still registered as fat profits. It was like selling your broken car to your dog, paying for it with your own credit card, then bragging about the revenue. Anyone with a calculator and common sense could see the contradiction. But Wall Street wasn't looking for contradictions. It was looking for growth. Authority bias did the rest. If the analysts called it genius, if the magazines called it revolutionary, then surely it was. After all, who wants to be the lone skeptic, while everyone else is doubling their money? But beneath the champagne, cracks were forming. Deals that looked golden on day one began rusting by year two. Cash flow didn't match reported earnings, but few asked why. Executives whispered about liabilities that didn't fit neatly into the narrative. The trading desk spun faster, layering bets upon bets, like juggling torches while the floorboards creaked. To admit weakness meant puncturing the dream, and dreams were the only real asset Enron had left. This is a danger of momentum stories. Once the world believes, it punishes hesitation more than failure. Investors demanded constant surprises. Employees feared slipping from genius to expendable, and managers stretched every number to hold the illusion intact. Outwardly, it looked unstoppable. Inwardly, the gears were grinding, and still the price climbed. The paradox was almost beautiful. The more fragile the company became, the more magnificent its value appeared. The market was applauding the mask, not the face. So the question lingered, whispered by skeptics in quiet corners, but drowned out by the roar of profit. What does Enron actually do? No one could quite answer, and yet no one dared press harder. Because pressing meant risking the party, and who wants to leave when the music is still playing? That silence was the company's greatest shield, but also its most fatal flaw. Every illusion has a limit, and Enron's was racing toward its own. Enron's hidden machinery whirred to life the moment a certain kind of finance mind took the wheel. A chief financial officer who treated numbers like origami and believed any liability could be folded into a swan. He didn't merely record reality, he authored it. If the street wanted smooth growth and zero friction, he would get a story that walked and talked. But stories need scaffolding, so he built one from entities that lived just beyond the company's front door. They were boxes with keys only he held, mirrors arranged to reflect profit wherever you stood. They called them special purpose entities, SPEs, which sound harmless until you notice the purpose was to make trouble disappear. Picture a rotten car that won't start. You sell it to a company you quietly control. Give that company your own credit card to pay, then announce, "Great news, I made a sale." The car is still yours. The bill is still yours. But on paper, you're a genius. That was the rhythm at Enron. Move the weakest assets to the side pocket, book a gain, and pretend the smell belonged to someone else. The elegance, if we can use that word, was how the pockets were sewn. Enron guaranteed the SPEs with its own shares, promises, and backstops. Losses teleported out of sight, while gains were carried into the living room for guests to admire. Mark-to-market added glitter. The moment ink dried on a long contract, all the imagined profit over years became today's earnings. Combine that with selling assets to yourself, and you could convert breath into confetti. It wasn't just aggressive accounting. It was financial storytelling with a bonus plan. If you've ever shoved unpaid bills under the couch when company arrives, you know the instinct. Only here, the couch had names that sounded like comic book villains and printer models. LJM1, LJM2, Choco Raptor. There were hedges that supposedly protected downside, except the hedger and the hedge wore the same badge. Raptor structures flapped in to absorb losses, like mythical birds. You don't need a CPA to sense the absurdity. You only need to ask one question. Who is truly on the other side? At Enron, the answer was often Enron, wearing a mask. Inside the building, incentives pointed one way. Make the numbers sing. Bonuses were pinned to reported profit, not cash. If a spreadsheet could be persuaded, so could your paycheck. Reality became a negotiation between last quarter's guidance and this quarter's courage. Meanwhile, a quiet memo circulated. Please direct more of your retirement into company stock. Loyalty, they said, is an investment. In truth, it was concentration risk packaged as culture. The people who loaded the bus were also sitting in the back of it. Executives understood timing better than theology. While rank-and-file employees funneled savings into Enron shares, the top brass exercised options and sold into strength. They didn't ring bells. They filed forms. The message to the team was hold. The message to their brokers was sell. You can feel the asymmetry without reading a single regulation. Those with the maps slipped through side doors, while those with the slogans queued at the main entrance. When a culture worships price, truth becomes whatever keeps the candles lit. And where were the referees? They were busy admiring the scoreboard. Analysts issued by ratings that read like Valentine's, often from banks earning fat fees underwriting Enron's deals, or designing the very structures they later praised. The Chinese walls between research and banking had the thickness of a napkin. When the model spits sunshine and the fee stream sparkles, skepticism becomes a career risk. Authority bias did the rest. If everyone smart calls it brilliant, surely it must be. The names alone tell you the mood. Raptor, LGM, Chuko. They sound silly because silliness is camouflage. It's hard to point to Raptor in a serious meeting without laughing a little, and that laughter smooths the slide to the next slide. Complexity was not a byproduct. It was a moat built from acronyms, footnotes, and inside jokes. The more complicated the diagram, the safer the scheme felt, and the farther real questions drifted from the table. Let's bring it home. Pretend your household has a shaky side business. You move its losses to an LLC controlled by your cousin, guarantee his debts with your salary, then tell your bank your main job has never been stronger. You even hedge the risk by promising that if the side business fails, your cousin will pay with money you lent him. In the short run, everyone applauds your savvy. In the long run, the bills find your mailbox anyway, only now they're larger and stamped with penalties. That was Enron's loop. Air in, numbers up, oxygen thinning. If you're feeling angry, good. Outrage is a compass here. Workers trusted the message and stacked their futures into a single ticker, only to learn the game was refereed by people counting ticket sales, not fouls. That's not a market lesson. That's a moral one. Yet, don't mistake this for closure. The illusion still held because illusions rarely collapse from elegance. They collapse from pressure. Somewhere, cash flow whispered a different story than earnings. Somewhere, a journalist sharpened a question. And somewhere, deep inside an SPE with a heroic name, a small crack began to spread. Keep watching. The mask is slipping and the room is running out of oxygen. The cracks in Enron's mask didn't appear as explosions. They started as whispers. A few people inside the company began to notice numbers that didn't add up, and not in the way accountants usually argue over decimals. These were structural contradictions. Profits without cash, hedges that hedged nothing, assets sold that never really left. One vice president quietly wrote a memo warning that the company could implode under the weight of its own accounting tricks. Imagine being the person who spots smoke in a crowded theater while everyone else insists it's just a projector. That was the tension. See too much and you risk your career. Say nothing and you risk everything else. Around the same time, the facade outside began to wobble. Jeff Skilling, the high-octane CEO who had sold Wall Street on the idea that Enron wasn't a pipeline company but a tech revolution, suddenly resigned. His explanation was as polished as it was suspicious. He wanted more time with his family. Executives don't usually step down from empires worth billions because they've just remembered little league practice. Investors smiled politely, but in private, the red flag was impossible to miss. You don't leave the fastest rising stock in America unless you know gravity is about to win. Journalists smelled the shift too. A handful of persistent reporters began asking the kind of questions that had been laughed off just a year earlier. What exactly does Enron do? And where's the cash? They dug into public filings, circled strange partnerships, and raised their eyebrows at related party transactions. In response, Enron doubled down on its defense mechanism, a fog of jargon. Presentations claimed the company was a revolutionary arbitrage trans-optimization platform that leveraged notional volatility in structured swap frameworks. In plain English, that means nothing, and yet the delivery was confident enough to stall many critics. If you've ever sat through a corporate meeting where the speaker uses 50 words to dodge one question, you know the feeling. Everyone nods because no one wants to look like the dumb one in the room. But curiosity has a way of spreading. Once the questions became too obvious to ignore, regulators stirred. The Securities and Exchange Commission quietly launched an inquiry into Enron's off-balance sheet entities. That phrase alone, off balance sheet, tells you everything. If something is too embarrassing to show on the main report card, it's probably not just a rounding error. The SEC wasn't ready to shout fraud, but the fact that they were looking at all was enough to rattle nerves. When referees stop watching the game from the stands and walk onto the field, players suddenly adjust their posture. Inside Enron, panic was hard to disguise. Whispers of lost deals grew louder. The culture of invincibility that once rewarded swagger began to curdle into blame. Employees who had been told they were the smartest in the room now wondered whether the room itself was collapsing. Some had bet their retirements on Enron stock, encouraged by managers who said it was loyalty and wisdom rolled into one. They watched the ticker like you'd watch a patient's heartbeat in intensive care. Every dip felt personal. The outside world still wasn't sure what to believe. Analysts, many of them from firms with deep financial ties to Enron, continued to issue buy ratings. Conflicts of interest whisper behind their polished language. You don't insult the company that pays your fees. For ordinary investors, that stamp of approval was reassurance, until the share price began to twitch. Small declines looked like buying opportunities, until they didn't. The illusion was cracking, not shattered, and that was the most dangerous stage of all. Suspense defined those months. Insiders leaving with vague excuses. Journalists publishing uncomfortable questions. Regulators sniffing around the edges. Employees staring at numbers they couldn't reconcile. The public still saw the glossy image, but behind it the gears were grinding. The smoke was thickening, and the first sparks of collapse were already visible. This was no longer a story about brilliance. It was a story about momentum running out of air. And once air is gone, no amount of buzzwords can fill the lungs again. It didn't start with a siren. It started with a footnote. Enron admitted accounting errors, a phrase so tidy it sounds like someone misplaced a stapler. But the numbers didn't just wobble. They fell through the floor. Billions that sparkled on slides went missing on paper. What had been profit became smoke. Traders are the only thing traders do when a story breaks. They sold. Funds that had sworn they were long-term believers became sprinters. Risk managers who'd been ornamental suddenly had authority. The price slipped, then skidded, then tumbled. $90 became 60. 60 became 30. 30 became single digits. In weeks, almost everything vanished. 99% gone. Not a correction. Gravity cashing a debt. The room finally believed the fall. If you held shares, you learned new definitions of time. Minutes became months. Every tick lower felt like a verdict. Ordinary investors, praised for believing the story, stared at brokerage apps like medical charts in a nosedive. Some tried to buy the dip because hope is stubborn. Others couldn't look at all. The math was merciless. A stock that falls 99% doesn't need a rebound. It needs a resurrection. Inside the company, the sound was quieter but crueler. Employees opened retirement statements and felt their stomachs drop. Years of matching contributions, bonuses taken in stock, to be loyal, invest in us speeches. They all reversed like a film running backward. People who had planned college, weddings, mortgages, and quiet Decembers suddenly did arithmetic at kitchen tables. How many months of savings remain? Which obligation gets paid last? It wasn't just money. It was meaning. Executives weren't doing kitchen table math. They had already done the arithmetic when the sun was still out. Options exercised. Shares sold into strength. Lawyers consulted. Explanations prepared. Liquidity needs. Diversification. Personal reasons. The same language that dressed ambition now shielded exits. When leadership tells a team to hold while quietly heading for the door, that isn't strategy. It's abandonment with paperwork. Publicly, Enron tried to slow the fall with familiar lines. Strategic review. Enhanced disclosures. The words were polished until they squeaked, but words can't pay invoices. Creditors asked harder questions. Counterparties tightened terms. Lenders called to revisit facilities. Bankers speak for show us cash or keys. The company's most valuable asset, belief, bled out faster than any liquidity line could refill it. Reporters who had once quoted press releases began writing in plain English. What is the real cash flow? Who owns the entities off the balance sheet? How can hedges be real when a hedger is also the insured? Each question cut a wire that had held the illusion together. Analysts corrected models with shaky hands. Buy became hold became sell became we are withdrawing coverage pending additional information. For employees, the collapse felt like a slow-motion fire. You still show up. You still answer emails. You still attend meetings where people talk about containing volatility, as if the building isn't already warm to the touch. The cafeteria gets quieter. Rumors race ahead of announcements. Small kindnesses matter. Someone leaves coffee on a desk. Then came the day when numbers met law. Bankruptcy. Not a metaphor, not a threat, but the filing that tells the world the heir is gone. Vendors line up. Creditors form committees. Employees receive notices that read like obituaries for paychecks. The stock, already a shadow of itself, flickers near zero. Markets move on because that's what markets do. Lives don't move on at the same speed. If you're looking for justice in a price chart, you won't find it. The people who trusted the message paid the bill. The people who designed the message hired counsel. Some kept beach houses and biographies intact. That mismatch lingers. Outrage meets schadenfreude, and neither restores a pension. So what do we do with this? We do not become cynics. Cynicism is disappointment dressed as wisdom. We become specific. We ask where cash meets story. We refuse comfort from language that hides more than it reveals. We diversify not because it's fashionable, but because concentration is a love letter to risk. We make peace with missing the rocket if the rocket can't explain its fuel. Enron's fall looked sudden from far away, but up close it was a series of small allowances. One accounting choice, one friendly entity, one quarter massage for visibility, one memo ignored. A culture that worships price will always be tempted to trade tomorrow for today. The invoice arrives eventually. When it does, it doesn't ask who believed the most. It asks who is left to pay. Markets will celebrate another miracle soon. Someone will promise certainty with better fonts. When that happens, remember this chapter. Ask questions early when asking still matters. The difference between 90 and pennies isn't genius. It's scrutiny. Practice it before the music starts again. When Enron finally collapsed, the shock waves didn't stop at the company walls. They traveled outward, pulling banks, auditors, and entire industries into the undertow. Investigators didn't just ask how Enron fooled the market. They asked who handed it the mask. The answer, uncomfortably, was almost everyone standing nearby. Start with the auditors, the supposed guardians of transparency. Arthur Andersen was once a titan, one of the big 5 accounting firms. Their job was simple. Check the books, confirm the numbers, tell the truth. Instead, they became Enron's accomplice. Not only did they bless the cook numbers, they also pocketed consulting fees on the side. The referee was getting paid by the team it was supposed to police. And when scrutiny arrived, Andersen panicked. Documents were shredded by the thousands, hauled out in FedEx boxes, fed into machines that coughed under the workload. Imagine an office full of professionals acting like a college dorm before a surprise inspection, except what they were hiding was the evidence of fraud measured in billions. The shredding didn't save them. Andersen was convicted of obstruction of justice. Practically overnight, a century-old institution dissolved, leaving 85,000 employees jobless. Most of them had never touched Enron's files. Collateral damage doesn't ask for your permission. It just happens. Outrage is justified here. Workers who did their jobs faithfully watched their careers evaporate because leadership chose complicity. Enron's arrogance infected its partners, and the infection spread until another giant collapsed. But Andersen wasn't alone. Major banks, J.P. Morgan, Citigroup, Merrill Lynch, helped structure the off-balance sheet entities that had Enron's debts. They earned their fees, praised Enron in public, and quietly collected bonuses. When the music stopped, they insisted they'd been deceived, too. None faced criminal trials, though many paid hefty fines. It raises a question worth carrying. When profit depends on silence, who in the system has an incentive to speak? Meanwhile, the spectacle of accountability played out in courtrooms. Executives once celebrated as visionaries now wore the labels of defendants. Jeff Skilling, Enron's former CEO, was sentenced to more than 20 years. Andy Fasto, the CFO who engineered the web of special entities, pleaded guilty and served 6. Ken Lay, the founder and figurehead, died before sentencing, leaving a bitter vacuum of unfinished justice. The very people who cashed out while employees were told to hold their retirement stock faced a reckoning they had tried to postpone. It wasn't complete justice. Millions in personal wealth had already been pocketed. But it was at least recognition that lies have consequences. Congress, embarrassed by the scale of the scandal, scrambled to reassure the public. The Sarbanes-Oxley Act emerged like a bandage after a car crash. CEOs now had to personally sign financial statements. Auditors had to keep a clearer distance from clients, and penalties for fraud grew sharper. Authority had been forced to act, not because it wanted to, but because the public demanded something that resembled a guardrail. Rules don't erase greed, but they can make the next leap of imagination a little harder. And yet, even as reforms rolled out, a bitter taste remained. Justice was partial, reforms reactive, and the wreckage irreversible. Employees never got their pensions back. Anderson's innocent staff never got their careers restored. Investors never recouped the billions that turned to dust. That is the nature of financial collapse. Punishment comes late, and the people least responsible carry the heaviest load. If there is any closure, it's this: illusions can't be endlessly sustained, and even giants fall when the truth finally catches up. Humor helps us cope. Remember the shredding frenzy. Accountants panicking like interns feeding paper into machines that jammed faster than excuses. But satire doesn't soften reality. Entire systems bent the rules for one company, and when it broke, it pulled others down with it. So when we talk about Enron, we aren't just talking about a company. We're talking about a domino effect. Auditors destroyed, banks complicit, laws rewritten, lives upended. And the lesson is less about pointing at villains than about recognizing the cost of silence. Because silence isn't neutral, it's permission. And permission, in this case, built an empire on air until the whole structure collapsed in a storm of shredded paper and broken trust. Enron's collapse was never just a story about balance sheets, executives, or auditors. It was a story about belief, ours as much as theirs. A $63 billion empire didn't rise because its numbers made sense. It rose because people wanted them to make sense. Investors wanted effortless wealth. Journalists wanted the next great business saga. Regulators wanted growth without friction. And employees wanted to believe their loyalty was part of something bigger than themselves. Illusion doesn't thrive in isolation. It thrives in the soil of collective desire. Think about how tempting the promise was. Here was a company that said it had cracked the code. Constant growth, endless innovation, risk eliminated through clever engineering. Who doesn't want to believe in that? When your neighbor brags about doubling their money, when magazines declare a firm most innovative 6 years running, when analysts repeat the same superlatives, doubt feels like ignorance. It's easier to nod along than to risk looking foolish. That's why illusions are so durable. They align with our longing to be early, to be right, to be included. But belief has a cost. For Enron's employees, it meant pouring retirement savings into company stock that later evaporated. For investors, it meant buying shares of a company whose earnings were nothing more than mark-to-market smoke. For society, it meant watching an entire financial system cheer as air was sold as substance. Outrage is natural, but outrage alone misses the deeper truth. Enron only fooled us because we wanted the miracle to be real. If this sounds familiar, it's because the pattern repeats. Look around and you'll see echoes in modern bubbles. Cryptocurrencies valued in the trillions without cash flow to support them. Housing markets where prices rise faster than wages. Startups promising artificial intelligence breakthroughs that will change everything overnight. None of these are guaranteed frauds, but all of them reveal the same dynamic. When the world is desperate for miracles, skepticism is treated like heresy. The line between innovation and illusion blurs, and fortunes are staked on the difference. So the lesson isn't to reject ambition or mistrust every story. It's to hold belief accountable. Ask what lies underneath. Does the cash flow match the claims? Do the incentives align with honesty? Is the growth sustainable without endless storytelling? You don't need to be an accountant to ask these questions. You just need to be willing to pause when everyone else is sprinting. That pause can be the difference between being swept into a mania and standing clear as the dust settles. Identity plays a role here. You can choose to be the kind of person who questions hype without apology. Not the cynic who mocks everything, but the disciplined skeptic who demands evidence before commitment. When you shift into that mindset, you stop needing to chase every rocket. You stop mistaking momentum for substance. And you gain the quiet strength of knowing that missing out on illusions is the same as winning. Because when the music stops, the skeptics are the ones still standing. The truth is that Enron was never as complex as its defenders made it sound. Beneath the jargon and the labyrinth of entities, it was a simple story. Heirs sold as wealth. That simplicity matters because it reminds us not to be intimidated by complexity. Complexity often hides weakness, while clarity exposes strength. If someone can't explain a business in a few sentences, maybe it's because the business only exists in the fog. As we close, remember the quote that has survived centuries. A lie can travel halfway around the world, while the truth is still putting on its shoes. Enron's lie traveled for 16 years, across magazine covers, stock charts, and conference stages. The truth eventually caught up, but by then the wreckage was already written. Your task and mine is not to stop believing in progress. It is to believe with discipline, to resist the seduction of miracles that require no questions, to learn from history so that error remains what it is and not what we mistake it for when the crowd is cheering loudest. And if you found value in this story, I'd invite you to subscribe to this channel, because here we dig into history not just to marvel at what happened, but to understand what it means for us today. Each lesson makes you harder to fool, stronger in judgment, and better prepared for the next wave of promises. So subscribe, stay curious, and let's keep learning these truths together.